The S&P 500 just closed at an all-time high, and your gut is screaming that a crash is coming, so you should sell now, while you're still ahead. Here's the uncomfortable truth. The math says acting on that instinct is the single most expensive mistake in all of investing. This isn't an opinion, it's numbers, decades of them, and over the next few minutes I'm going to show you exactly what they say. 4 things: what actually happens after a crash, the hidden trap that punishes sellers twice, why your own brain works against you, and what the data says to do instead. And keep one line from one of the greatest investors who ever lived in your head the whole way through. Start with the fear itself, the crash. In 2008, the S&P 500 lost 37% in a single year. From its 2007 peak to its 2009 bottom, it fell 57%. More than half the market gone. If you were ever going to sell in a panic, that was the moment. It genuinely felt like the end of the financial world. And then it did what the US market has always eventually done. By 2013, it had erased the entire loss and pushed on to brand new record highs. And it's not ancient history. In 2020, COVID crashed the market 34% in just 33 days, the fastest bear market ever recorded. Anyone who panic sold in March of 2021 watched the market claw all the way back to a brand new record high less than 5 months later. Go back further. On Black Monday in 1987, the market fell 22% in a single day, still the worst day in Wall Street history. It was back to its old highs within 2 years. Or the dot-com bust. From 2000 to 2002, the S&P fell about 49% as the internet bubble burst. Painful, slow, and yet by 2007, it had made a brand new high, even the one most people still feel. In 2022, the market fell about 25% as inflation and rate hikes hammered stocks. It was back to a fresh all-time high by early 2024. See the pattern? Every single bear market in US history has been followed by a recovery that went on to a new all-time high. Every one. Now stocks don't only go up. From 2000 to 2009, the index went basically nowhere. It's a lost decade. That part is real, and we'll come back to it honestly. But even then, the investor who kept calm and kept buying through that decade ended up owning the entire 2010s bull market that followed. Hold on to the one word that separates the winners from the rest. The loss was always temporary. Selling is what turned it permanent. Now the word everyone's terrified of, recession. A recession has an official definition, and notice what it's about. The economy, not your portfolio. Jobs, spending, output, that's the economy. The stock market is a different animal. It's a bet on the future, not a snapshot of today. Here's the part that breaks people's brains. The 2008 and 2009 recession officially ended in June 2009, but the market had already bottomed 3 months earlier, in March. By the time the recession was declared over, the market was already up about 40% off the lows. Everyone waiting for the all clear missed the best part. It works that way because the market leads the economy, not the other way around. Stock prices are people betting on next year, so they turn up long before the data does. Perfect example. The market bottomed in March 2009, but US unemployment didn't peak at 10% until that October, 7 months later. If you'd waited for jobs to recover, you'd have missed the whole launch. The market never rings a bell at the bottom. It turns while the headlines are still terrible, which is exactly why you can't afford to wait for the news to feel safe. This is the chapter that changes how you see a crash forever. When you sell in a crash, you think you're dodging the worst days. But the worst days and the best days aren't far apart. They're practically neighbors. According to JP Morgan, 7 of the 10 best days in the market over the last 20 years happened within just 2 weeks of the 10 worst days. And it's not a coincidence. The biggest up days are born from fear. They're the violent snapbacks that happen right in the middle of the panic, when sellers least expect them. So the panic seller gets hit twice, they lock in the loss on the way down, and then they're sitting in cash when the rebound explodes back up. And look what missing just a handful of those days does. $10,000 in the S&P over 20 years, fully invested, grew to about $65,000. Miss the 10 best days, just 10 across 20 years. And you end with less than half. The whole game was decided by a tiny handful of days. Put it in plain returns. Staying fully invested earned almost 10% a year. Missing just those 10 best days dropped you to under 6. Same 2 decades, same market, a third less every single year. And it gets worse. Miss the 60 best days and your $10,000 shrinks to about $4,000. You don't just underperform, you lose money in the greatest bull run in history. Here's the cruel chain, start to finish, the one that traps almost everyone. The rebound isn't optional, and it isn't predictable. It happens in a handful of violent days you cannot time in advance. The only reliable way to catch it is to never leave. And zoom out far enough, and the noise disappears. Despite every crash on this list, 1987, 2000, 2008, 2020, $1 left in the S&P back in 1980 is worth more than $100 today, with dividends reinvested. If the math is this clear, why do smart people still sell? The answer is your own brain. Nobel-winning research uncovered something brutal about how we're wired. So when your portfolio is down 30%, the pain doesn't feel like 30, it feels like 60. And that pain peaks at the exact moment selling is the worst possible move. And it has a measurable price tag. Morningstar's Mind the Gap study found the average investor earns about 1% a year less than the very funds they own. 1% a year, compounded over decades, is hundreds of thousands of dollars, paid not for owning bad funds, but for bad timing, for flinching. It gets amplified by the herd. The headlines scream, your feed panics, your neighbor sells, and fear feels a lot like wisdom when everyone around you is afraid. Add recency bias on top. We assume whatever just happened keeps happening, so we feel most confident at the top, right before the fall, and most terrified at the bottom, right before the recovery. Which is why the most famous line in investing is a deliberate instruction to do the opposite of your gut. And the phrase that talks you into selling is almost always the same one. It's not stupidity, it's biology. The same brain that kept your ancestors alive by running from danger is the one screaming at you to run from a falling market. In investing, that ancient instinct is dead wrong. So burn this in. The market doesn't take your money in a crash. Your reaction to the crash does. Now let me argue against myself, because a video that only tells you the good news is lying to you. After the 1929 crash, the US market fell almost 90%, and it did not fully recover for about 25 years. It always comes back can mean a very, very long wait. And it's not just history. Japan's market peaked in 1989, and didn't reclaim that high until 2024, 34 years underwater, a whole investing lifetime. And here's the honest catch. The US has been one of the best performing markets in history. Researchers Dimson, Marsh, and Staunton showed plenty of countries did far worse. Betting everything on one winner is survivorship bias. So the lesson was never blindly hold any one stock or any one country forever. It's the disciplined version of staying invested. 3 honest conditions. Own the whole market, not one bet. Spread across countries, not just yours. And give it a real-time horizon. This is for years, not months. And the closer you get to actually needing the money, the more you shift toward bonds. So a crash the year you retire can't force you to sell stocks at the bottom. Staying invested is a strategy, not a dare. So what do you actually do? At a record high today? Or in the next crash? First, understand the asymmetry you're betting against when you sell. Bulls and bears are not the same size. And here's how little timing really matters. Schwab studied a saver who had the worst luck alive, investing only at the market's peak, every single year. Even he crushed the person who stayed in cash. Read that again. The world's unluckiest investor still beat cash by a fortune, because he stayed invested. Time in the market beats timing the market, every time it's measured. The only person who reliably lost in that study was the one who stayed in cash, waiting for the perfect moment that never came. Waiting has a cost too, it's just invisible. To turn it into a plan you can actually hold. 4 moves, none of them dramatic. Picture someone who kept adding $500 a month right through the 2008 crash. Every red month, that same 500 bought more shares, cheaper. So they didn't just recover, they came out ahead of the person who waited to feel safe. That's the quiet magic of automating it. When buying is a standing order instead of a decision, fear never gets a vote. You keep buying the dip without ever having to be brave. The emergency fund is the secret weapon. It's what lets you leave your investments completely alone, because your rent never depends on selling stocks on a red day. And rebalancing does the hard part for you. When stocks crash, your plan tells you to buy more to get back to target. It forces you to buy low when every instinct says run. No willpower required, because a crash to someone still contributing isn't a disaster. It's the same companies, on sale. The headlines call it a collapse. Your future self calls it a discount. So back to today, with the market at a record high, don't try to call the top. Keep your contributions on autopilot. Top up your emergency fund while times are good, and write your crash plan now, while you're calm, not in the panic. Because the plan you write today at the high is the only thing that will save you from yourself on the day it all turns red. So should you sell because the market's at a record high? History's answer is blunt. A record high is the normal state of a market that keeps climbing. The mistake was never being invested at the top. It's not being invested for the recovery. The crash will come. They always do. The all-time high you're staring at today will one day be the level the market falls back to and then blows right past. That's not the risk, that's the deal. So if this made the next crash feel a little less scary, subscribe. Next we break down the 4% rule, the number that tells you when you can actually retire. Educational, not financial advice.